Are you a podcaster? Maybe you've got that big idea and you're looking for a network to join. The multi-award-winning Ozcast Network can get your content to eyes and ears all over the world. Join now for the first month free, and you could be featuring this sound at the beginning of your podcast. Ozcast. Simply head to ozcastnetwork.com for details.
The information contained within this podcast does not consider your personal circumstances and is of a general nature only. You should not act on it without first obtaining professional financial advice specific to your circumstances.
Paul Atherton is an ex-Wall Street advisor on a mission to help young people win back their financial power, wealth and security. He does this by helping them understand the hidden world of finance, risk and investments, helps them figure out how it impacts them, and to seize the opportunities to make it work to their advantage. This is Paul Street Journal. I'm here this morning with Paul Atherton. How are you, Paul?
How you doing, Tim?
Doing well. Listen, mate, I'm really wondering who sets interest rates?
I mean, which interest rate? Equation.
That's a good point.
Mean the interest rate on your mortgage?
Well, I mean, that's got to come from somewhere, though. That's not arbitrary. Where does it come from?
All right. So, and your credit card would be the other thing. I think, look, by the time it gets to the consumer level, it's dependent on what I call risk. So it's it's the individual's probability of default, one, and the lending institution's probability of clawing back some assets. So if you have a credit card, there is no assets pretty much that they're going to be able to, a lending institution is going to be able to claw back. Mm-hmm. And credit cards are notoriously the area where people default first. So interest rates are going to be higher. Interest rates are higher because risks are higher and lower clawbacks. But you know, if we'll just take a step back, I think we did cover that a little bit in one of the podcasts, but what ultimately sets the base rate is not really well discussed. So you'll hear on the evening news that the RBA, the Royal Bank of Australia, or the Fed in the United States have kept interest rates on hold, or they're thinking about raising rates or lowering rates, or etc. Now, for what does that mean for everybody? Like, if you hear that, what does that mean? It doesn't mean anything. So ultimately, even your mortgage, well, particularly mortgage, I should say, has a base rate. There's a base at which it cannot go below, even though they might want to, and that's set by the government, set by the Fed in the United States, or the RBA for us. So it's called a central bank. So governments have central banks, and they set the rate at which interest rates, the lowest interest rate available in the risk-free in the markets, cash rate, and it's a rate at which they lend to commercial institutions. Now, ironically, commercial institutions don't tend to lend directly from the government. They tend to lend from various institutions, including wholesale institutions. But it's available. And that sets the standard rate. If it goes up, and they usually go up in 25 basis point increments.
As in 0.25?
Which is 0.25%, 25 basis points. So I guess economics talk. 25 basis points or 0.25%, well, guess where that will go? So now it's a little bit more costly for a lending institution, a commercial bank, to run their operation, and it's a little more costly. They do not keep that. They charge you, the consumer, the mortgage holder, so they pass that on through to you, the lucky consumer. So the base rate's the overnight rate. Now, why do they set the base rate? Well, it's meant to do two things. It's meant to keep inflation at bay and keep full unemployment. Okay, so it's a bit of a combination. Now, if you think about the lower interest rates think about releasing the spigots on a valve, the more money that flows into the economy. Why is that? Because your mortgage is now cheaper, your loans are now cheaper, the banks have extra capacity, and that feeds into the economy. So you've effectively released the spigots with interest rates going lower. And if they go higher, it's the opposite. They tighten up. And tightening rates means lending is more difficult, and perhaps it's too difficult for you to take a loan. So we're in an environment for the last decade since post-GFC where interest rates have been rapidly decreasing and they to almost zero. And what does that mean? Well, that means you can now get a mortgage for very, very cheaply.
Mm-hmm.
Why is that? Because you can afford a cheaper mortgage because your interest rate payments are so much lower. That means you can afford a bigger loan. And the effect of interest rates, I often think of an interest rate on asset prices like gravity. The higher the interest rate, the higher the gravity, the more difficult it is for a company to earn money. It lowers stock prices, I guess. Or your mortgage is now more pricey because real estate, and therefore real estate goes down. Tends to be mitigated, I guess, with an increasing interest rates. The opposite is true if it goes down. So if we have lower and lower interest rates, you can afford more and more, and then with that, you can buy more of a larger house, and then you would expect with lowering interest rates to have increased asset prices, so real estate, housing market, and also for the stock market. And is that something we've seen? Well, that's exactly what we've seen.
Yeah.
We've seen a booming stock market and what often people call a bubble in the housing market. And now we're in a bit of a change, I think. So the Fed has been in a tightening phase, so interest rates are going up. That's the overnight rate.
And that's been by just 25 basis points most of the time.
Small increments. And that has an impact. It impacts, right? It means what new loans are being made. Can people afford the same level that they could before? The answer is no. So you have to find the cash from somewhere or not buy it at all. It's more expensive for people inside a loan. Now that's, by the way, that is true for most of the world except for the United States, because most US mortgages are fixed. So once you have the fixed rate, you're fixed. So increasing interest rates don't necessarily affect your mortgages.
Right.
But they do affect renewed mortgages. So the effect is there, but it's somewhat blunted by
that
fixed rate.
Post GFC that they're all mostly fixed?
No, that was historically been the case.
Really?
Yeah. Whereas in Australia, the UK, most of the world, it's variable. So the cost of any interest rate increases by the government, or the RBA, or the central bank is passed directly onto the consumer, which is not the case for the US. So there we are. So interest rates set by the basic base interest rate, which we call the overnight rate, or the bank rate, or the official cash rate, various words for it. It's the rate at which the central bank lends to commercial institutions or commercial banks, and that sets the lowest interest rate that's available. Because if you think about it, that's the full creditworthiness of an entire government.
Yeah.
And of course.
Yeah. So that would mean that if the interest rate is going up, it is a reflection upon the creditworthiness of a government? Or
So interest rates are going up, meaning, so what is the central bankers in charge of keeping interest rates under control and employment, in full employment. Okay, so if the rates are going up, they're probably worried about inflation. So the economy is, what they might say is overheating, or there's a booming economy. Well, that's fine, just raise interest rates. That'll take the boom out of the market. If you think about it, this is exactly the direction that it happens. If there's a worry about the economy, they'll lower interest rates immediately. If there's oh my gosh, we're heating up, there's full employment, potential signs for inflation, let's raise interest rates.
If the commercial banks are not borrowing from the RBA, as you kind of mentioned earlier, wouldn't that mean that the raising of interest rates or the cash rate by the RBA, wouldn't that mean that wouldn't affect the commercial banks? Or is it because you can't legally go lower than what the RBA sets the cash rate?
It's not a legal rate. It's
sorry.
the market rate.
Okay.
So as soon as the central bank sets that rate there, that will be the lowest rate that's available.
Okay.
And it sets the standard.
Sure.
So it's not so institutions do go and tap into it, but essentially that is the rate at which you can, the lowest rate at which you can borrow cash, and it's overnight.
Okay.
But you see, there's another thing called a yield curve, and a yield curve is, I think of it like a bunch of dots drawn with interest rates on the y-axis and time over the x-axis, and it's sort of upward sloping in general. So the lowest rate is overnight. That's 0 1 day. That's and the cheapest you can get. Then over time and maturity, you get increasing interest rates, which various institutions will borrow from, and that's what a commercial bank will want to do.
Okay.
Think about it. They want longer term loans, and that's where you'll get from wholesale institutions.
So maybe perhaps another time we could talk about whether people should be looking at fixed or flexible.
Yeah, and how maybe to navigate the various times where you see interest rates raising and lowering, and which is good and which is worse. I think a nice way to think about it from an asset perspective, housing and stock markets, think of interest rates like gravity. Higher interest rates, the tougher it is for stocks to earn income. I still think it's the best way. In fact, I'm sure of it. Real estate will have equally, perhaps even more of a problem because, again, it's gravity on the asset price of housing.
Thank you for that, Paul.
Cheers, Tim.
Paul Street Journal.
Are you a podcaster? Maybe you've got that big idea and you're looking for a network to join. The multi-award-winning Ozcast network can get your content to eyes and ears all over the world. Join now for the first month free, and you could be featuring this sound at the beginning of your podcast.
Ozcast.
Simply head to ozcastnetwork.com for details.